Welcome to TheoTrade. This is Don Kaufman, July 24th, 2024. It's a Wednesday afternoon, and spoos are getting rocked right now with 15 minutes to go to the cash close. Look, helmets on, people, because volatility has arrived. Let's get right down to it here in this TheoTrade evening video. So as I was saying moments ago, S&Ps are down some 120 handles. You know, in terms of statistical significance, well, still only a 2% move, but the day is young. And I got to tell you, the NASDAQ, though, it's taken a hit. That is 3.3%. But what I'm watching right now, and to get really specific with you, take a look at the SPX, the mother of all products, driving towards the lower edge of an expected move. Now, if you're sitting at home and thinking to yourself earlier today, like, oh, how come he's not selling any options yet? Look, the expected move is absolutely unequivocally in play. There's no rush to go out there and to put on any positions because we're very likely to hit this 5420 handle. Now that's 5420 specific, again, to the SPX, as I call it, the mother of all products. And it does appear that we're going to drive into that lower edge of expected move. The expected move inside of the SPX for the entire week is roughly plus or minus about $85. And if you saw really what's going on today, well, it's kind of shocking because look where we came from. I mean, there was a point yesterday where we literally came within a few points of hitting the upper edge of expected move. Here we are, because when I say volatility has arrived, I mean it. We're right now facing the lower edge of that expected move, and that's one of the most pivotal places on the screen. Now, I'm going to come back to that lower edge of expected move in just a moment. I want to have a look around, see where some damage is being inflicted. But let's be extremely forward-looking. Let's not just state, oh, volatility has arrived. Of course it's arrived. Is more on the way, okay? And some really kind of contentious areas, at least for me, in this marketplace. So first of all, a lot of people are going to mention, well, it's Tesla driving some of the volatility. No question, right? But look, Tesla, for the most part, opened down between 10 and 12%. That was its kind of opening range, right? It's about 10%, slipped to like a 13%, but for the most part, Tesla opened down. It didn't continue to progress down like what? Like the S&Ps did, and they're continuing their progression. Google, okay, is still kind of in its opening range. So I simply don't want to hear like, oh, it was all Tesla. It was Google that sparked this. To me, I think it has a degree of little Google, little Tesla, a side order of political and geopolitical uncertainty possibly hitting this marketplace. But overall, look, okay, you bring up the spiders, okay, and you look at, umpteen weeks and months, if you will, of buy side. There's not much two-sided trade over here. Getting a little serious out there. I mean, today is the first time I'll actually tell you that. And again, we haven't even hit the lower edge of the expected move, but it's getting a little bit serious out there. Why do I say that? Because of volatility. Again, you can look at tech all you want. It's 11% move here. NVIDIA's taken a hit by the tune of about 6.5%. Okay, but newsflash, it's about volatility. Volatility at this point. Okay, and by the way, this is not a gap. That's not a gap. That's actually a contract roll. So just completely negate that. But what you are seeing right now is volatility has gone parabolic. Right now, that is a daily chart. If you look at an intraday, you'll see exactly what I mean. And the concern at this point is, okay, very simply, again, moving forward. When I say helmets on, I mean it, because we haven't gone yet, okay, into any type of volatility backwardation. But oh boy, we're close. And that is going to be the story moving forward. And there's two aspects that really resonate with me, okay, that the proverbial risk could hit the fan from here forward. And again, we look at this, you're like, but it's a 2.2% decline. Yeah, but all you're seeing right now, this is the spark, if you will, that could ignite a much more substantiated, okay, and longer term volatility, okay? With that, why am I pointing out these vol futures? And a lot of people don't look at them, but you're actually looking at August vol futures that are trading like 1705, right? And those have, okay, 28 days. Then you look a little further out to the SEPs, okay, and those are roughly 1740, right? And those SEPs, roughly speaking, have 56 days remaining, okay? So this is 28 days, this is 56 days, and right now, the volatility skew has really kind of flattened out. This morning, the differential, which is presently 35 cents between these two, this morning that was closer to 65 cents. So we've actually cut, okay, that differential in half pretty much in this trading session. And if you're not familiar with volatility futures, that's fine. What it basically implies is short duration risk is very close to eclipsing longer duration risk. When you think about this and like, what does it mean in context? If you have 56 days, okay, a lot can happen in 56 days. Okay, a lot more can happen in 56 days than can happen in 28 days. But lo and behold, the risk is hitting pretty hard right now, so much so that you can say, well, in 56 days, the world can explode. More that can explode in the next 28 days. And that makes sense, right? More time, more uncertainty. But we're getting so wild right now in this marketplace, and in a short duration, these volatility futures are skyrocketing. And what can happen is they're like, no, 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 no. In 56 days, okay, the world could actually calm down because it's exploding right now. And in this next 28 days, okay, this volatility future is so critical because the whole trading world is short. They're caught short, okay, these 28-day vol futures. What they do is they short the shorter duration and they go long the longer duration. And when they invert, okay, that whole trade flips over. And when they do invert, I'm going to tell you exactly what happens. Okay, they go and they start selling S&P futures to mitigate exposure that they're taking in the short-term volatility futures. And it becomes a wild feedback loop, all right, where they start losing money in the vol futures and they start selling S&Ps. And if they sell S&Ps, then it reverberates back into the entire S&P 500. And if you start selling the S&P 500, it makes the volatility futures go higher, which basically in turn causes them to have to sell more S&Ps. And that is critical. And I'm going to tell you right now, you're not home yet. How do I know you're not home yet? You're not home yet because we're not in high degrees of correlation. The one thing that's really dangerous here, okay, outside the fact that the volatility futures have yet to invert, that's right, the volatility futures have not inverted yet, okay? The most dangerous aspect of this marketplace, hands down, is that we're not only not in correlation, we're not even near it. Okay, I got 62 decliners. Look, the way I see this, there's 38 other things on this screen that you can sell the living crap out of. That's bad. Because if you're going to sit here and you're going to start preaching to me about, well, it's capitulation. You can't capitulate without correlation. I'm not saying that we can't bounce. I'm not saying that we can't bounce, but don't dare tell me, okay, that we're anywhere near capitulation. This is a short-term sell-off. Could be a short-term sell-off, but you realize if this correlates, okay, this can get a lot more extreme. Speaking of which, look at what this is going on right now. I waited to actually record this because, come on home, because we're home. You're actually seeing right now, we just hit the lower edge of the expected move. That is why I started with that, okay? Just a few minutes ago, I started with, look, I think we're going to come down to the lower edge of expected move. I don't think there's a reason to jump out and start like, let's do this and let's do that. If we're at the lower edge of the expected move, don't worry, okay? You can ride down there. We're going to be there tomorrow, right? And I'm going to tell you, so you're going to watch these vol futures, which have kind of gone parabolic. You can look at stuff like VVIX, the volatility index. Oh, look where this is. Almost up to the 110. 110 is the extreme. It's what we kind of call the VAMA zone, right? So where volatility, nobody gives a damn when you get above that 110 region. Things get all kinds of wild. Volatility, though, again, the futures have not inverted. But boy, coming into this close with 4 minutes to go, it's getting wild out there. See, you can actually literally see, right, in real time, this differential drop to like 30 cents or even 25 cents. Right? We were just talking about 35 cents. It's actually contracting right now and getting ready to flip over. I mean, this is it, people. This is starting to get a lot more intense. As I said, helmets on, because volatility, right? it's arrived, it's here, and it's things are getting a little bit more wild out there. So watch the volatility futures for inversion. That would basically mean you're in the throes, okay, of some longer term risk out there. The next thing, you got to see higher degrees of correlation. If you're one of the people that are like, I need a bounce, you want to see this thing correlate to the downside. You need to see somebody capitulating all over the floor, and we're not even close to that. And there's pockets of strength in here. We're still seeing a little bit of the rotation gain. Stuff like ExxonMobil is up. I mean, don't get me wrong, they're smacking a couple of stocks out there, okay? But we're smacking what is probably long overdue, stuff like NVIDIA. A little perspective over here, NVIDIA, which cracked through this 120 level. Look at the year-to-date percentage on here. Don't worry, it's still up 137%. And that's just some wild, wild numbers. Okay, last thing to mention here on this evening's video, moving forward. You really want to know the most critical aspects of this. Again, we literally tagged the lower edge of the expected move. The lower edge of the expected move, again, 54.20. Because of the extreme nature of volatility, right? Okay, there's degrees of movement off of this level. As I said, I was going to come back to this, right? This 54.20, and that pertains, again, to the SPX. Give it approximately plus 15 points or minus 15 points. And you go, what do you mean? Well, 54.20, okay, minus 15 takes you somewhere down, okay, to right here, which would be right around 54.05. You start to get below that level, all hell will break loose in this marketplace. That, okay, is what we're aligning to possibly do tomorrow. And I say, I want to give you a definitive level. I'm not going to sit here, okay, and tell you like what the earnings are going to be tonight or what this is going to look like tomorrow. But I am unequivocally going to tell you that this level, okay, right and around, okay, this 5400, 5405 is going to be critical, because if you cross through it, what's going to happen, right, is those, right, that were trading on the expected move, they're all going to have to turn around and sell S&Ps. If they sell S&Ps, it's going to cause the volatility futures to explode higher. I mean, volatility futures are up, don't get me wrong, they're up like 15%. As I said, though, we're not home yet. Going to watch these levels carefully. I'll talk about them extensively tomorrow while live on TheoTrade. But people, okay, this is the volatility, it's long overdue. We've been waiting for it. A lot of positions are actually working out very, very nicely right now. But again, we're home. Keep your helmets on. Volatility has arrived. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.